Ticker symbol JKHY has returned to 16% in the past year. And boy, has 2023 been a wild ride for this one. Just look at the lows it hit in November 2023, and then it rose all the way back to its highs just in February of 2024. Today, we'll be looking at a great company with consistent cash flows, which is a very predictable stock with solid fundamentals, high efficiency ratios, and highly stable revenue and free cash flow growth. So today we'll be looking at Jack & Henry Associates, a financial solutions company. In their annual report, they say that they provide the technology solutions to help banks innovate faster, strategically differentiate, and successfully compete among them. They generate revenues by providing support and services provided by their cloud services for any customers that are hosted on the cloud services. And they also offer a recurring electronic payment solution. The usual contracts that they sign are 7 years long on average, but there are many with one of their biggest clients which are actually longer than these 7 years. And this is amazing because it's a recurring stream of income and they can focus on attracting different clients. So this is why they have such predictable growth in their revenues and in their free cash flows. They have laid out a growth strategy for the future, which has 3 parts. The first one being the cross-selling of complementary products and services. But what does this mean? Well, this means that if, for example, they are already hosting a customer in their cloud service, well, by cross-selling, what it means is that they will then offer any other services or products that they offer, such as their recurring electronic payment solution, to that customer that they already have, with the objective of improving the customer lifetime value. The second growth strategy is to develop long-term technology modernization strategies to provide cloud solution to their banks. And the third one is to capitalize and expand using their own acquisition strategy. And this is a company that has a lot of experience in acquisitions and which has been growing thanks to them. As such, we can see that they have actually managed over 35 acquisitions since 1999. That's more than one a year. But this company becomes more interesting when we look at their financial analysis. They have a fantastic return on capital employed of 17%, an interest coverage of 32 times, which is above the 10 times that we usually look for in companies, and they have a solid cash conversion of 79%. We usually like to see this value of 90%, but 79% is pretty close, and we like that. This is basically the ratio that states how good a company is at converting their net income into free cash flow. Then the profit margins are sitting at 41%. And the operating margin at a solid 23%. This is what I was talking about predictable growth. Look at how solid and how stable the growth in revenue, operating income, and net income is. And this is highly attributed to the fact that they are signing extremely long-term contracts and that the majority of their income is recurring. This is as beautiful as a chart as you can get because you can add to this their incredibly stable gross margin at 42% and their incredible operating margin at 22%. This stock is fantastic and is as predictable as you can get, which is what we love in this channel. They have an operating cash flow of $402 million a year. This is also extremely stable. It has been down over the past year. However, it's still stable and getting back to where it used to be. They are investing around $211 million a year, which is really high. It's about half of their operating cash flow. However, they are also using the other part of their operating cash flow to pay back their finances and all the debt that they used to have. Now, when looking at the ratios, we can see that the important ones for us, the return on invested capital and the return on capital employed, are also extremely stable and in a very good spot with 14 and 22% respectively. And now, in terms of debt, they do have some interest and some debt that they're paying back. However, their interest coverage ratio allows them to be in a very safe spot. In terms of fundamental analysis, this company gets a very solid 7 out of 8, as starting with the fact that they have very low liability risk, as we have just seen with their interest coverage ratio. They have an extremely solid balance sheet due to the fact that they can pay all their short-term debts with their current assets, and as we have seen, they're extremely consistent with their cash flows. This company also ticks the box of dividends and share buybacks, not because they pay a dividend, but because they conduct share buyback programs. And this company, of course, since they're providing solutions which they generated themselves and which are based on their know-how, they have a huge chunk of pricing power. They then have organic revenue growth, which we have seen, and the one thing that doesn't tick the box is the organic free cash flow growth. However, the most important point in this slide is the fact that they do have an existing moat and a competitive advantage, which is huge. And this is based on the fact that, first of all, the majority of their customers and their revenues are based on long-term recurring contracts. As we have seen, the average life cycle for one of their contracts is 7 years. And this is as big of a moat as you can get, because basically any customer that you get, you're going to keep him for the next 7 years. And if you do a good job, chances are that you will sign another contract, which is another 7 years. And in those 7 years, you're basically is as if you had a patent with that customer, because he cannot hire anyone else as he has to finish the contract with you. So this is a beautiful business model. This company follows secular trends as they're all about digitalizing banks and using cloud services, which are extremely trendy right now, especially in banks and professional service solutions. However, this company can approach growth in 2 different ways. First one, focusing on geographical expansion, going to different countries such as Canada, which is the neighboring one, or moving on to the UK or even other European countries where there are a lot of banks that are in need of these services. The other leg of growth potential would be to develop new offerings so that they can cross-sell them to their customers, which is already one of the strategies that they're implementing. In terms of valuation, this company is overvalued when looking at the discounted cash flow by a staggering 50%. However, if we're analyzing it using relative valuation metrics, this company is actually undervalued by 10%. And what is relative valuation? Well, this is when you compare metrics such as the PE ratio, the price to earnings to growth ratio, the price to sell, or the price to book ratio. Well, this company, when compared to its peers, seems undervalued by about 10% in the relative valuation scenario. However, when we're analyzing this using the free cash flow yield, we get a 3.06%, which is a bit higher than the long-term inflation rate, suggesting that this company may be at an attractive valuation right now. Some risks and possible challenges that I do see for this company is, first of all, the worsening of the competitive landscape, and I only put a 50% for this one because of the existing moat that we spoke about previously. I do think that this is a risk because this is a very profitable and a very competitive industry where competitors are innovating a lot and coming up with different strategies and solutions to gain more clients or more bank customers. However, I'm not really worried since Jack Henry & Associates has such a wide recurring customer base that they basically have a patent, as I stated before, over these clients, and they will probably be recurring as long as they provide useful solutions. In terms of regulation, I don't see any upcoming regulation changes that will hurt the operations of Jack Henry & Associates, and I don't see them missing out on their performance objectives. And additionally, even if there's an economic downturn, I don't think that its operations will be harmed in any way, since they are geared towards making banks work in a more efficient way. And banks will need this even if there's an economic boom and even if there's an economic recession. Before moving on to the investment conclusion, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence before jumping into the stock. However, I believe that this company has a strong competitive advantage, that it has consistent, predictable, and resilient cash flows, and that it has a high return on capital employed, meaning that it can actually create value for the investor. Overall, I believe that this is a great company and a great investment with high predictability that may be worth actually taking a deeper dive into. So thank you for watching. As always, this has been the Cashflow Compounder. You can join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic or Trading 212.